Hey, good morning, options traders, and happy Monday to everyone. Well, I wanted to talk a little bit about another hidden cost of rolling. You've heard me talk in previous videos about the break even point getting shoved further away, and we'll do a quick review of that as well. But there are others, and one that a lot of traders overlook, especially for long term trades, is the hidden cost of compounding. And so, for anyone who likes to trade, let's say leaps options, you're in it for long periods of time, or at least that's your goal, is to stay in this potentially for years and years and just continue to roll this position. Or maybe you're using shares of stock and selling out shares of stock over time, trying to hedge the amount that you have into it. And that's fine, but there is a hidden cost, and you need to understand that hidden cost before you figure out how much to take off the table. So, how does this work? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, as promised, quick review of rolling. Remember, this is just a technique that we use for calls and puts. And whenever you hear the word roll, it just means to switch, or we're going to roll two different strikes or expirations. Now, there's many types of rolls. We have a roll up, a roll down. You can roll in and roll out. Whether you're using calls or puts, all of these are viable types of rolls. Now, for this video, I'm just going to be talking about the roll up with calls, but the same argument can be made for a roll down with puts. So, why do we roll? Well, remember the basic idea is about risk management. You're trying to reduce the amount of money in the trade. So, remember to succeed as investors or traders, you are risk managers, you are not profit managers. So, one of the ways that traders use with options is that we will roll calls up and we will roll puts down. That's a very basic technique, and what it will do is to produce credits for you. So the reason that you get credits from rolling, again, assuming that we're talking about the same expiration date, is that lower strike calls are more expensive. So if you have a 100 call versus the 105, we know that the $100 call must be worth more money. It gives you the right to pay less for the shares. So traders recognize that's a benefit to pay less, and so they bid the prices of those lower strike calls higher. Now, the opposite is true for puts. So, higher strike puts are more expensive, again, assuming the same expiration date. So, if you have the 105 put compared to the 100 put, we know the 105 put must trade for a greater price because the higher strike put gives you the right to receive more money when you're selling your shares. And of course, for sellers, that's a benefit. So the whole idea of rolling these calls up or these puts down is that we generate credits. So it's a way to sweep money off the table, so to speak, and continue to hold an option to capture further gains if the stock continues to move in your favor. So for example, let's say that you buy the $100 call for 6. So remember, we always get a bend at the strike. So this is our risk graph. But now let's say that the stock moves in your favor and you're able to roll from the 100 strike to the 105, perhaps for a $4 credit. And this is very easy to do in your broker's platform. It's a single trade. It's actually selling a vertical spread. And I've talked about this in previous videos with the details if you want to see how that's done. But you're simply going to sell the 100-105 vertical spread. One transaction. And once it executes, you would move from the red line to the blue line. See, notice that our bend is now at 105. We've sold the 100 strike and we now own the 105 call. But we also generated a $4 credit. And so I've lifted the maximum loss here from 6 up here to -2. I spent 6 on the trade, I collected $4 back, so now effectively I have $2 into the position. So the main reason for doing the roll is to continually reduce the amount that we have into the position. It's a risk management technique. Now, one of the costs is that we're going to push this break even out a little bit further. So if we paid $6 for the 100 strike, that expiration break even point is 100 strike plus the $6 paid, or 106. And you can see that this red line crosses zero. That's the break-even point at 106. However, if we now own the 105 strike at an effective cost of 2, the break-even gets increased from 106 to now the 105 strike plus 2, or 107. So you can see that that red line is pushed forward a little bit from 106 to 107. And so what's happening there is that synthetically, when you received a $4 credit, you were actually mathematically paying $1 for the put. So you could go out and buy the 105 put for $1, or you could roll to the 105 call for a $4 credit, and you're doing exactly the same thing. So that is a cost. Even though traders hear the word credit and they think, oh, I get to sweep credits off and it's like money falling from the sky, just continue to roll. And that's not true. This is one of the costs. And of course, what we're trying to do over time is to roll, let's say in this case from the blue line, eventually up above zero. So you can see that the blue line sits below zero. We could still lose, albeit only $2 instead of 6. But after, in this case, the second roll, I've gotten myself above zero. Now the worst that can happen is I've got a $2 credit. So you can see that this whole section right here has gotten shifted above zero. So the worst that can happen now is that we make $2. We spent 6, I've collected $8 back. That's a $2 gain on 6, or a 33% return guaranteed, but I still have unlimited upside. So again, this is where a lot of traders get a little bit overzealous and they think, oh, this is the greatest thing. Let's just continue to roll. Well, that's one cost, is this idea of pushing the break-even points forward. But there's another that's even more devastating for longer-term trades. So longer-term trades have an additional cost that is always overlooked by traders, and that is compounding. You see, as you're sweeping this cash off the table, you now have less money that can compound over time to grow. And people don't realize how powerful that compounding force is. So as you're reducing the amount of money in the position, you also are taking the ability to make more money away in the future. So to demonstrate, let's go over to an Excel spreadsheet. So here's an Excel spreadsheet, and what I've done is I've allowed the user to create a rate that you're earning, let's say 10% per year, or it could be 1% per month. It's some type of a rate. And then we're going to have an amount that we're going to withdraw, let's say from the rolls. Now, typically for the options, we're peeling off 80% of the difference in strikes. So if you're rolling for a $5 difference in strikes, let's say from the 100 to the 105 call, generally you're going to shoot for about a $400 credit. Just to make the math a little easier, I'm going to say that it's $500. So if you want, think of this as maybe trading shares of stock. And we're going to put $10,000 into the position. We're going to earn 10% per year. But every time that we increase by 10%, we're going to sell off $500 worth of shares. Or in the case of options, we're going to roll for this type of a credit. Now you might think, hey, wait a minute, for stock, you could run out of shares. And that's true. That's one of the drawbacks to trying to roll or to hedge shares of stock by selling off shares. But for this model, we're just going to assume that maybe the stock splits all the time, so we always have shares that we can sell. But mathematically, it works out exactly the same. So let's take a look at trader number 1, who is, let's say, a buy and hold. And this is his balance. So after the first year, he has 10,000 plus 10%, or 11,000. But in year 2, he's got 11,000 that increases by 10%. So he goes to 12,100 and on down the rows, all the way down here. Look at this, after 20 years, 67,000 plus. Now we're going to compare him to another trader who rolls. And again, this could be shares of stock, which we typically don't call a roll, but we're just going to be selling off some of the cash. So let's say after the first year, now he starts with 10,000. At the end of the year, he's got 11,000. The rule is every time he increases by 10%, he sells off $500. So his position is 10,500. That's the value of the position, but he also has, at this step, $500 cash, also for a total of $11,000. So right now, after year one, there is zero difference between these two traders. But look what happens as we move through time. After the second year, trader number one has 12,100, but trader number two has 12,050. So right now there's a $50 difference between the two, not real big, or he's about 0.4% behind the trader who does not roll. But look what happens over time. After, let's say, the 10th year down here, look at that. Trader number one has got $25,937. Trader number two has a total of just under $23,000. So he's behind by almost $3,000 or 11.4% behind. Well, that counts. Look what happens after 20 years. Now, trader number two is behind by over $18,000 and nearly 28%. So this is the part that traders just fail to recognize, that every time you're peeling money out of the position, you're also reducing the ability for it to grow. And it becomes exponential. You can see right here, this graph is this difference right here. So it's getting bigger over time. Again, not real big in the short run, but a very big difference in the long run. So again, that's why it doesn't make a huge difference if you're, let's say, rolling shorter term options. But if you continue to do that over the long run, it makes a massive difference. Now, it all comes down to the difference in these ratios, not so much what you started with, but let's say we're going to keep this at 10%. What if you peeled off $1,000? Well, now, look what happens. After 10 years, you're down about 23% from rolling, and after 20 years, down 55%. See, what's happening now is that every time the second trader is generating a 10% return, or $1,000, he's peeling off all of those returns. And that's something that a lot of traders do. I'm not saying it's a bad thing to do or that it's wrong. I'm just saying there's a hidden cost to it. So now you can see that this trader's position will always be worth $10,000. This would be a little bit like a constant dollar technique where you're just trying to keep your balance at roughly 10,000 each year. But what he's doing is he's sweeping this into cash. All right, so now it looks like it's a great thing because look at this. After 10 years, this trader can say, hey, I've gotten all my money back. I put $10,000 into it. Look at this. I've got $10,000 sitting in money market. So now I have no risk. And yet I still have shares. What a great thing. Well, okay, but if you hadn't rolled, you'd have almost 23% more money. And after 20 years, 55% more money. Now, what happens if you're peeling off more money or rolling for more cash than what you're generating? So let's say you're earning 10% on a $10,000 investment, but you're selling off $1,500 worth. So each year, this $10,000 is making $1,000, but you're taking $1,500 off the table. All right, so yes, it is true that you can get your cash off the table sooner. You can see you've got $10,500 sitting in your money market after 7 years. So again, it looks like you've gotten all of your money back plus a nice return. But you can also see that you're tapping into principal. You're just kind of getting a return of your own money. That's why these numbers start going negative. You're not earning enough to even generate this $1,500 credit without depleting your principal. Now look at the difference. After 10 years, you're down 34%, even though it seems like a sensible strategy because you get all of your money back sooner. And after 20 years, down 83%. So again, the idea of this isn't to say that it's wrong to roll. I've got lots of videos on rolling. I'm a big believer in rolling. I do it all the time. But for longer term positions, I'm definitely less aggressive than most traders. A lot of people want to roll those positions at the first sign of credits. And I think it's better if you really try to hit the brakes on it for this very reason. If you're going to be a long-term investor, whether it's with stock or with options, then be a long-term investor. Part of the reason for choosing that strategy is so that you can get the compounding in your corner. And if you start peeling off this cash really aggressively, there's a hidden cost. And remember, you're not going to see it missing because it's going to be money that's just simply not there. It's going to look like you did well because you'll say, hey, I've got more money than I started with. But you're not going to realize the cost. And the main thing to take from this is that remember, every time that you peel money out of the position, you are also reducing the ability for that position to compound. And this is where your hedges, rolls, and morphs can come in to actually create better scenarios than just rolling, especially for longer term positions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.